Pretty stellar rally that was a follow-through of Friday's move. What's the sense that you're getting when it comes to that PSU basket that really shone in trade? Is the rally here to stay?
Hi, good morning. I think where we saw the markets rallying yesterday and on the Friday, and obviously an important day on the politics side that that thumping victory what BJP got. So I think obviously the PSU was one of the clear winner what we saw like yesterday, and I think going forward also if the PSU basket can outperform, and if we see from last 6 months, most of the PSU stocks have corrected also in terms. Obviously, few of them had gone way ahead of their earnings, and few of them was trading below their valuations, which were very attractive. So I think two baskets to be made very clear in this entire PSU basket as a whole. One is obviously your PSU banks, which holds the topmost, what we feel that PSU basket holds the topmost allocation as a PSU as a whole, with the PSU banks earnings. If we look at it last 3-4 years versus the earnings which they reported this quarter, because most of the banks reported very strong earnings in terms of asset quality, in terms of if we look at NIMs, or in terms of any other area and growth, if we talk about. So most of the banks reported a strong earnings in PSU packs. So that obviously requires that one should have a good allocation. Second comes, I think, a lot of power financials and power as a sector. I think in stocks like REC and PSC, again, reasonably valued with a good dividend yield, with a good 18 to 20% growth, what they've been talking about, and the sector is poised, and the power financials will definitely do well in next at least 2 years or so from here, and with the visibility of earnings. So again, that gives us a sector where one should look at. And thirdly, I think obviously in select pack of metals and so on and on, one should look at it. And we feel that it should the PSU as a whole should continue to do well.
Nuresh, what is that big trade for December? I mean, this is that big trade. You would say that you're happy to execute it today with the assumption that you would keep it before at least till the year end, which is a month. But what is that big trade according to you, Nuresh?
So it would be a mix of stocks, but on dips, there could be two sectoral bets which I would take going forward for the month would be, say, looking at banking and financial. So a mix of private banks, so something like Axis Bank and HDFC Bank, which are both on the opposite side of the spectrum. You have HDFC Bank, which is trying to break out. You have Axis, which is trying to make a base. And then keep looking out for a bunch of small PSU banks, whether it could be a Bank of India, Union Bank of India, PNB, which could bounce back. And other is IT names, which is where we are seeing some breakouts happen. So there could be a Wipro and Tech Mahindra. So this could be the two baskets which you want to play for momentum, and then maybe small caps and mid caps which could be breaking out, so that would be on radars. But as of now, those breakouts are say a preemptive, say from something like a Piramal Enterprises which is trying to break out. But I would go with banks and IT to be accumulated over the next few sessions on any fade off move in the markets.
Kunal, what is that big trade for you in the month of December? Like egg trade, no BTST, only buy today, sell next month. क्या हुआ? Buy today, BT buy today, sell next month. लंबा हो जाएगा.
So I think in terms of the trade, I would look out for private sector banking names. So basically the point is, Tikuj, that we are looking out for a start of a potential trend for the index, or even if there is no trend, there is a consolidation, there is slight bit of choppiness. We find the leadership sectors. Now in every new trend which restarts for the index, there are new set of sectors, new set of stocks which establish themselves as new leaderships. So I think in this regards, we've seen the last 2-3 weeks, there has been strong resilience which has come back into few private sector banking names. I'm not putting all the stocks in one basket, but for example, you have Federal Bank, which has been doing pretty well. You have HDFC Bank, which I think yesterday made a fresh lifetime high for itself. So these are very strong candidates of continuation outperformances. Then you have the IT index, and within the IT index, apparently it's the mid-cap IT stocks which have done exceptionally well in the last 3 months or so. So there was a point where large-cap IT stocks were doing well. Now the mid-caps have taken or moved by a very strong margin, and the large-cap IT stocks are lagging slight behind. So I would believe that large-cap IT stocks can make a strong comeback over here. So the likes of TCS, Wipro, for example, looks very attractive. So I think these would be the two key pockets where I would concentrate in terms of the leadership sectors going into the month of December.
Okay, stay with us. Meantime, as the credit economy gets democratized, large private banks will be the biggest beneficiaries, according to Morgan Stanley's Rhythm Desai. He believes that banks will ride the capex upcycle and turn around amid healthy macros. Listen in.
Low-hanging fruit is private sector, large private sector banks. They're trading like utility stocks. Utility stocks, by the way, are trading like growth stocks. 10 years ago, the large private sector banks, the top ones used to trade at 3, 4, 5 times book, and the utility stocks were trading at 1 to 2 times book. Now, utility stocks trade at 4 to 5 times book, and the private sector banks trade at 2 times book. So I think if you want to make a trade, it requires an enormous amount of patience to go through this, because I don't know when the tide turns. Everybody is very cautious and skeptical about the banks, but that's, I think, the trade you want to put on in the market right now. So that to me is the low-hanging fruit, but it's difficult to digest this because it may not give you immediate gratification. So the trade there is to buy the large banks with good deposit franchises and good risk controls, because they will be the biggest beneficiary of this democratization of credit that I think is underway.
Okay, the bank which has surprised everybody is Federal Bank, and no one saw this strength coming, but it is real. Kunal, is this stock into a new trend now? 6 month, 32% higher?
Yeah, Nikunj, absolutely. In fact, in this leg of correction also, the stock did not break below its key moving averages. Was one of the first ones in the private sector banking names, of course, to come back to its life high levels of 210, 212 approximately. And now in the last 1 week or so, when the markets are, found some bit of stability and trying to get back into momentum, the stock is making new highs for itself yet again. So classical ingredients, classical signs. And I've always believed that whenever a stock changes its behavior in terms of the beta nature, from being extremely high beta, V-shaped corrections, V-shaped rallies, towards more of slow, gradual recovery into the stocks, those are the kind of indications that the stock has changed its trend and now is looking out for much more stronger multi-month, multi-year upside also. So I think that aspect, Federal Bank looks very attractive.
Okay. Rahul Shah, what are your thoughts on Federal Bank? I mean, everyone acknowledged that it was cheap, but the big turn for Federal Bank has come ever since the new management has taken over.
Yeah, so I think obviously the stock has been, as you rightly pointed out, it's at all-time high, and if we look at this last quarter's numbers are also pretty strong. So my sense is, I think whenever we see a strong management and a strong in terms of numbers, sooner or later the markets gives the valuation. So I think Federal is one of them, and we also continue to like Federal from current levels as well. So we feel that there could be another 20% upside more from the current levels in a Federal Bank.
Okay, meantime, we were just discussing this a short while ago, Rahul, this, comparison of Swiggy versus Zomato. And in light of that, there's a new report from UBS, and they're saying that Swiggy is well placed for growth at a 35% discount as compared to Zomato, and talking about encouraging signs when it comes to quick commerce. How do you think investors should play into this space?
So I think if we look at it as and what is market looking at it and where the markets are putting money is most important. Most of the platform stocks. So wherever you have this new age platform stocks, people are just putting their money, and the valuations have just been created in terms of the price appreciation. So if you look at Swiggy versus Zomato, yes, Swiggy trades at discount, right? And other hand, with a Zomato with a strong earnings and a strong turnaround with all the pockets, they've been doing quite well. So my sense, I think both the stocks should do well, Zomato versus Swiggy, and obviously the preference will be more on the Zomato with more visibility of earnings and so on versus Swiggy, which has been a recent listed. So I think both will do well, but the earnings in terms of way both will compound. I think almost both of them will compound at 15 to 18% from here. So big money to be made in any correction, as I think both the stocks one should look at investing.
Okay. Here are some more thoughts from HDFC AMC, and we'd spent 18 hours, spent the entire day at HDFC AMC's head office, and The sense what you've come back with is that look, the long-term bull market is intact. Valuations are not that stretched. Froth is getting diluted in this market. This market cannot be called as cheap, but this market surely, like what it was in the month of September and October, almost like euphoria, that euphoria surely has faded away.
Government's big focus on manufacturing, on infrastructure, that is another very, very big thing, right? I mean, in last few months, people have kind of course, because the valuations went up and then maybe some of those stocks have corrected with the with some bit of disappointment on the earnings side. But I think post this election, we are all expecting in next few months a big order flow from the government, which will revive, which will kickstart again the public capex, which will give confidence. I mean, you need to inject cash and the confidence in the system, which I'm pretty sure government is doing it. And we will see the private capex also kicking in. So there are many, I mean, India always says a stock picker's paradise. India is a stock picker's paradise.
Domestic pharma is growing 7-8% without volume growth. So if volume growth comes back, then that's a little bit on top. Hospitals are growing reasonably well, occupancies are high, and US generic price declines are easing. So what used to be 7, 8, 10% is now coming to 2, 3, 4%. So overall, the environment is reasonably positive, and that creates the opportunity for more ideas. But you have to drill down to a company-specific level, and when we do that, we find a lot of well-run companies, and hence we are overweight on pharma. But it's stock specific.
A pickup in mass consumption and huge under-penetration in the automotive sector itself in India, I think that you should look at some of our holdings. In addition, I think that we also have a very strong auto components industry, and which is globally competitive as well. And you will also find holdings in our portfolio in the auto component space, which is not just beneficiary of Indian demand picking up, but generally competitiveness in the global space, where we are seeing some softness in demand, but I think perhaps just cost competitiveness will also make market share gains.
We would expect RBI to consider rate cuts sometime in 25, maybe Feb or maybe even April, but the view is that interest rate cuts have been delayed but not denied. I think over the course of 25 we will see a shallow rate cutting cycle. 25 to 50 basis points is on the cards, and given the positive demand supply scenario for Indian government bonds, we would expect yields to head lower over the medium term.
All right, that's the take from HDFC AMC. Meantime, let's also get in a sense as to what JP Morgan has to say when it comes to the entire IT basket. And they're talking about the ER&D space in particular. What the pecking order is very clear. KPIT Tech, Persistent, L&T Tech, Cyient, Tata Elxsi, Tata Tech. Those are, that's really the pecking order. And they're talking about the growth and valuation premium and how that has, to IT has shrunk. Curious, Rahul, as to where you stand. What's the pecking order when it comes to some of these players?
So I think if we look at the Q2 earnings, I think most of the IT companies fared well, and the demand came back in most of the IT mid-cap names, which was very clear. And we have seen that most of the mid-caps IT names have been near to their highs of 52. And if we look at again, once the demand is there and the earnings reported of most of the IT companies were good, so this will continue. So my sense, I think mid-cap IT names will continue to do well better than the large caps. Obviously, the large caps have the better valuation metrics right now in terms of the mid-caps. So with the mixed bag, if I have to give me the order, I think Coforge remains our top bet, followed by Tech Mahindra, HCL Tech, and TCS. So these are the mix of large and mid IT names, what we have been liking.
Meantime, the HUL board has given the in-principle nod for the demerger of the ice cream business into a separate entity, which will eventually be listed independently. And the company said that this decision to demerge is going to be placed before the board early next year. Let's understand the details and the contours of how this is going to work. We've got Snehi joining in with the details. Snehi.
Well, yes, HUL is in focus because the board has accorded an in-principle approval to demerge their ice cream business, and this will be turned into an independently listed entity. HUL has decided to demerge after considering different modes of separation for the ice cream business. When we interacted with the management during Q2 numbers, they also said that they were mulling different options like a stake sale or an entire demerger, and they've decided to go down the entire demerger route. Now, the rationale, they say, is to maximize value for all the shareholders of the company, and it is proposed that the shareholders of HUL will receive shares in this newly listed ice cream entity in the proportion of their shareholding in HUL. The decision to demerge is subject to approval of the board and the shareholders, and this decision to demerge will also be placed in front of the board anytime early next year. So that's the rough timeline that we have on this demerger right now. Let's understand the contribution of the ice cream business to the overall HUL business. And analysts say that ice cream contributes roughly 3% to HUL's overall annual top line. So the ice cream business revenue roughly translates to 1800 crores annually, and analysts don't expect to see much impact on HUL, and HUL will be able to focus on core businesses, is what analysts believe, the likes of their home care, beauty and well-being and personal care business. And lastly, just to run you through what Q2 looked like for the ice cream business, in Q2 ice cream volumes have remained flat on a year-on-year basis. So that's the update that we are getting from HUL. That's the big update, and HUL will be in focus on the back of this ice cream demerger that they're planning to do.
Why are they looking at taking the ice cream business out? Obviously, it means that they want to sell out the ice cream business. They've not found any buyers. Ice cream is a business which, in a sense, is a business which requires a lot of upfront investment. It's a business which tends to impact the aggregate portfolio, and it is not a critical business for HUL in terms of where the market share dynamics are moving. And with so many small players now coming in, the ice cream market, in a sense, clearly seems to be having different dynamics. I mean, I've always wondered that you travel anywhere outside India, you see ice cream is a big business. Even though India is a warm country, the ice cream business is not as large as what the other developed and emerging market countries really have to offer. So it's always a mystery to me that why ice cream in India has not become such a large business, even though now the refrigeration and other things have started moving up. Kunal, we've been discussing HUL, and it's a stock where you're getting a sense that the bottom formation has started.
It started, but I believe that it will take a lot of time for these FMCG stocks to make a very strong, durable bottom for themselves, because the way in which these stocks have been sold into, that was on the back of higher volumes, higher intensity in terms of prices. Now, what you can probably see for initial part would be maybe a rebound of sorts. So, for example, these stocks on an average have fallen by 20% broadly. So, you might probably expect a 5% to say 7-8% kind of a recovery from their previous swing lows for many of these names. But eventually, a retest of the previous lows is what should decide that whether these stocks and when would these stocks form a durable bottom for themselves. That could be on the back of maybe another round of selling pressure for these stocks. And then I would probably believe that a more of a time-wise or a price-wise consolidation is what should play out. So that's typically how these stocks generally form a bottom, because the inherent nature of these FMCG stocks is not high beta, and that's why whenever these stocks form a bottom, they would typically tend to consolidate for a longer duration of time. So I believe that one should not be looking to hurry up into just about trying to buy these stocks at current levels. Price-wise, yes, maybe these stocks are very attractive, but in terms of a start of a durable trend, I would believe that should be some time away.
Okay, that's the take coming in. Meantime, Naresh, let's get a sense from you as well as to what the outlook is on some of those real estate counters on the charts.
On real estate, DLF looks interesting. It's bounced back from the same support band of 750 odd levels, which was the low in June, and has bounced back sharply in the last two sessions. Any fade-off move towards 810 would be a buying opportunity. Second, we could be looking at Godrej Properties, which has also made a strong comeback. Any move towards 2800 and 2850 would be a buying opportunity. So overall, we've seen a strong bounce back, but an entry point could be a little dip in the next few sessions if it comes. But overall, the strong comeback should continue over the next few months, is the view.
Well, SGX or GIFT Nifty is indicating that we are in for a gap up start. Now, from Thursday's low, it's almost what? How much points, Kunal? Almost 2,000 points for the Sensex.
Yeah, almost 2,000 points.
So what
1,000 points for the Nifty.
1,000 points for the Nifty.
Yeah.
1,000 points for the Nifty.
Yeah, from the lows. 23,200.
Thursday's low. Yeah, Thursday.
23,200 approximately, and we are almost at 24,200, 300. Wow.
So that means markets are no longer oversold now.
Yeah, no.
So that entire oversold bounce which we were talking about on Thursday morning, that is over.
Yeah, that initial pop is over for these stocks. Now what should matter is that which are the leadership sectors which should play out for the index. That would determine the strength of the trend going forward. So the first move is done. This is the expiry week, which means that the effect of the bounce should also be carried forward to the next series.
So Naresh, just coming on that aspect, markets were oversold. We got a monster rally on Friday. We got good follow-up on Monday. What happens next?
So the target for this move is closer to 24,500, 600. So a risk reward trade comes in when you get a dip towards 24,100 odd levels. So keep a stop loss of 100, 150 points and expect a 400 pointer move up. So ideally, this move should go towards 24,500 odd levels. Similarly, the most important part is Bank Nifty has made a stronger comeback. So if that takes leadership, it becomes easier. And post 24,500, 600, you take a review whether we can go towards and test the 25,100, 200 mark, which was the previous swing high. So overall, looking at it as a buy on dips for now, the 2-day bounce can see a fade off going forward. If that comes, that should be a buying opportunity.
All right. Meantime, L&T Finance is also going to be in the spotlight on back of commentary from their meeting with analysts. Let's put the spotlight on the company's plans, what they're targeting over the next 3 to 4 years. We've got Varun here with the details. Varun?
Well, so in the analyst day, the company has actually focused on the digital transformation that the company is doing, which will help the company, get future ready. So there are certain things which will help the company from the digital transformation. It is the focus on scaling up the low-cost acquisition, the improved productivity, faster rollout of new products and projects, and also geographical expansion and pan-India footprint. Also, the company is working on a project which is called as Project Nostradamus, which is aimed at automated portfolio management engine with predictive risk management, which the company is targeting to launch in the Q3 of FY26. Also, the company aims to grow the overall book size 2 times in the next 3 to 4 years with a loan CAGR of around 20 to 25%. The two-wheeler segment that is expected to deliver a 20% growth versus a 24% growth in the last 3 years. Also, the personal loan segment is expected to deliver around 15% loan. The credit cost is expected to be steady at around 2 to 2.25%, and also the ROAs are expected to be around 2.8 to 3%. The company says that the urban portfolio is expected to do better than the rural portfolio, although the company would be focusing on increasing its rural footprint and also rural financing opportunities. On the microfinance business, the company has said that the disbursements actually in the month of October has moderated to around 15 billion, and also the collection efficiency has been impacted and now it stands at around 99.3%. Also, the project Cyclops is planned to go live by December 2024. So there are several initiatives that the company is taking, what the company said in the presentation, and the growth prospects and how the growth would be delivered, especially focusing on the digital transformation, which will make the company future ready.
All right, those are some of the key parameters that the company is focusing on. Thanks very much. Rahul, have you assessed L&T Finance? They're talking about ambitious targets. What's the outlook? If you can unmute yourself, Rahul. Yeah. Okay, I think we're facing a bit of an issue when it comes to the audio, but let's get in a chart check then. And Kunal, what's your outlook?
So I think L&T Finance, I think the stock seems to have disappointed because, there was a point when the stock was 180.85. It was very close towards breakout the 200 mark, which has been a major psychological barrier resistance for L&T Finance. But, the stock has seen a lot of false starts for itself. There was a point when the stock was, closer to the breakout level. Volumes were pretty much on the stronger side. But then we saw the stock just about getting into a very sluggish kind of a trend. And now I think closer to 150 odd levels, the stock seems to be coming back towards a support point. So maybe there could be a process of a bounce for the stock on the very short term basis. But I believe that an eventual retest of the previous breakout 180 plus levels, I think that could probably decide that how strong could be the up move. So traders could play out for a 5%, 7% kind of an upside, but really this stock has been in huge underperformer, and that too at a point when many of the financial services name were doing pretty well for themselves in the mid part of this year.
Okay, that's the view coming in on L&T Finance. Meantime, Naresh, the fact that Reliance Industries has been through quite a tumultuous ride of late, what's the chart reading today?
So in the last 2 days, it has made a decent bounce back. Now, going forward, what we need to see is how it behaves around the resistance point of 1350, 1360. Now, that was the earlier low for the stock back on June 4th. We broke below those levels after trying to consolidate. So for now, that would be a stiff resistance. And we could be getting into a range-bound move wherein 1250 would be a bottom and 1350 could be the top. And for some time, we could be trading on this range. So closer to 1250 is a buy, closer to 1350 is where you want to book some. But overall, seems like a short-term bottom is in place. And now we get into a consolidation mode and make a base around this area.
Take on the Nifty Bank Index, given that rally that played out yesterday. Of course, that was perhaps a one-off. It's not going to be consistent. But what is that reflective of in terms of levels now around the 52,200 mark?
Yeah, I think we could be coming very close towards a breakout of the previous ranges. So, for example, in the last 7-8 weeks of the market selling, 52,500 was the level which we tested 3 times for the Bank Nifty broadly. And on all 3 attempts, there was an intraday breakout of the 52,500 mark, but we never failed, we failed to cross above those 52,500 levels. And there was a point when the Bank Nifty fell below 50,000 mark after the third retest, which means on the way up, 52,500 would now be the first major resistance which the Bank Nifty should retest. Now, if we see a breakout of the 52,500 mark for the Bank Nifty, then I believe that we could be looking at least another 500 to 1,000 point plus rally for the banking index, making it come very close towards a lifetime high level. So I think the level which I think one should be looking out for in terms of a potential breakout for Bank Nifty should be 52,500.
All right. Meantime, the investor community has once again expressed confidence in banks and consumption. What is the outlook on valuations? Let's hear it out from some of the big honchos of the market. Rhythm Desai, Lawrence Balanco and S. Narain as to what their outlook is on these spaces.
Trade there is to buy the large banks with good deposit franchises and good risk controls, because they will be the biggest beneficiary of this democratization of credit that I think is underway. Coming out of COVID, rural India took longer to witness the transfer of terms of trade from urban India, but that is now set. And therefore, I think consumption will actually see all-round recovery. The slowdown in urban consumption that a lot of consumer companies are complaining about, I think is temporary. Because India's per capita income is rising, discretionary consumption will grow much faster than staple consumption. And I think we are only seeing reiteration of those trends, whether it is with respect to quick commerce, whether it's respect to leisure, travel, education, entertainment. I think these areas are certainly going to grow faster than soaps and staple stuff.
Banks for us is the key sort of overweight in this, and we call it the bull market from the COVID lows. It's had, of the COVID lows, it's been the state banks that led the recovery and a key driver to the upside. What we've seen in relative terms now is a comeback in the private banking space. And, one of the charts that I've looked at closely and watching closely is HDFC Bank, because a breakthrough the 2790 area, we think from a large cap stock perspective would be a significant breakout. And that would sort of generate some leadership in the next leg up towards that 37,000 area.
I would say that the areas where things are still reasonable is banks at this point of time. Clearly, I would say then, many of the consumption sectors have done badly for a long period of time. The valuations, even after doing badly for a long period of time, is not dirt cheap, but they can give relatively better returns maybe.
Okay. Rahul, progressively from here, after the correction, give us a list of 2-3 stocks or maybe one large cap, one mid cap, maybe 2 mid caps, where you think that 2025 could be a year of double-digit returns.
So I think, Nikunj, if we look at 2-3 stocks on the large cap space, obviously large cap offers a lot of room and comfort versus the mid caps. Now, after the recent correction, I think the large cap still offers a valuation comfort. So in large caps, obviously the clear winner we discussed was financials. So in financials, we continue to like State Bank of India. So that could be a double-digit return from here. Auto, which had a very fantastic this year, and I think we looks like that going forward also in auto, there will be more of a stock specific. So if I look at Mahindra and Mahindra, so Mahindra and Mahindra also had a decent correction, strong numbers of Q2, and it looks like again going to be a robust Kharif season and good monsoon as well. So I think M&M could also be a good play. And thirdly, I think metals play. I think metals had a washed out in a lot of stocks, but I think Hindalco amongst them had decent numbers. So I think these are the list of 3 stocks that we continue to like from here.
Thanks so much, Rahul, for sharing with us your market outlook. That's the pre-open rate then at the bottom of your screen. And despite what we saw in Asia, it is looking like a fairly decent start on the Nifty. Indications